Hello everyone, I am Neha Malu from Vinod Kothari and Company, and today I'll be deliberating on distribution of accumulated profits to the shareholders, its various ways, corporate law and tax implications. So let's get started. So at the very onset of our today's session, let's just first have a look at the agenda. So first of all, we'll be discussing as to what is an accumulated profits and what are the different modes of utilization of the same. Post which we'll be seeing bonus issue provisions with respect to bonus issue, buyback and dividend as various ways of distribution of accumulated profits to the shareholders. And at the end, we'll also be seeing a comparative analysis of the three modes which I just mentioned, so as to understand which particular mode becomes more beneficial to the company in different circumstances. So let's get started. First, as to what is an accumulated profit. So accumulated profit is actually the credit lying to the retained earnings, which is built through undistributed profits. Now, this is actually shown in the balance sheet under the head of reserves and surplus. Now, if the company has accumulated profit, so the various modes with which it can utilize the same are three, which the company can opt in any of the permutation combination it wishes to. Now, the modes are, first of all, to invest the same. So, for example, there are nice lucrative schemes available, so the company may consider using its accumulated profit and investing in the said schemes so as to earn good returns from that. Or if there are, say, for example, some projects which the company needs to fund, or there are some working capital requirements, then the company can also consider retaining its accumulated profit in the business only. And the third mode of utilization is to distribute the same to its shareholders. So the company can, as I was already mentioned, that the company can opt for any of the permutation combination when it comes to utilization of its accumulated profits. Now, when it comes to distribution, as we can see from the infographic presented on the right side of the screen, like the various modes are reduction of share capital, or going for a bonus issue, or buyback of shares, or through dividend. So we'll be discussing. So in this particular presentation, I'll be majorly focusing on bonus issue, buyback, and dividend as different modes of distribution of accumulated profits. Now, when it comes to distribution, one important point which is to be noted that in case of Section 8 company, they are strictly prohibited from distributing its accumulated profits to its shareholders. Reason being, Section 8 company are formed for a specific purpose and it can use its fund only in funding of those particular projects. Therefore, when it comes to distribution of accumulated profits to the shareholders, it is strictly prohibited in case of Section 8 company. Now moving ahead with bonus issue. So bonus is actually, in case of bonus, there is no direct outflow of cash from the company and only shares are issued to the existing shareholders in a specific ratio as decided by the company. Now, when we speak about the legal framework that revolves around bonus, so whether it is a listed company or an unlisted company, it has to comply with Section 63 of the Companies Act and Rule 14 of the company's share capital and debenture rules. So this is with respect to all the companies, whether it is listed or unlisted. However, when it comes to listed companies, in addition to Section 63 and Rule 14, it also needs to comply with Chapter 11 of the SEBI ICDR regulation. So this is with respect to the legal framework. Next, the various sources with which the company can go for bonus issue are capital redemption reserve, securities premium, and reserves and surplus. It is to be noted that the utilization should be in the same hierarchy as I mentioned. So since capital redemption reserves and securities premium are specific reserves, so while going for a bonus issue, the company first needs to utilize its specific reserve, post that it can go for the general reserve. Therefore, first CRR is to be used for the purpose of bonus, next securities premium, and then free reserves. Now, when it comes to securities premium, it is to be noted that as per ICDR regulation, only that portion of securities premium can be utilized for the purpose of bonus, which is actually realized in cash. Now, for example, say the company has purchased a plant for say rupees 15,000, for which it has issued 1,000 shares of rupees 10 each at a premium of rupees 5. So in this case, the securities premium of 5,000 rupees, which is not actually received in cash cannot be used for the purpose of bonus. Also, reserves created out of genuine profits can only be utilized, and reserves created by just mere book entries cannot be utilized for the purpose of bonus issue. Next, with respect to conditions, as conditions for bonus issue, I've divided this into two particular halves. One is conditions for all the companies. So it doesn't matter if it is a listed company or unlisted company, it has to comply with these all conditions listed over here, which are the bonus should be authorized by the articles, shareholders approval by way of ordinary resolution has been obtained, and the company has not defaulted in payment of any of the statutory dues of employees, which involves gratuity, PF, etc. And partly paid up shares, if any, has been made fully paid up. So, for example, the company have huge reserves which it wants to utilize for the purpose of bonus. However, the shares are partly paid up. So, for example, the share was of rupees 10 and it is paid up to rupees 8. Then the company can also consider going for a bonus call first and thereafter a bonus issue when the shares become fully paid up. Next, these two are quite simple points that bonus once issued cannot be withdrawn and bonus cannot be given in lieu of dividend. So these are the conditions which are to be complied with all the companies, whether it is listed or unlisted. However, when it comes to listed companies, there are some additional conditions pursuant to ICDR regulations, which are the company has not made any default in payment of interest or principal in respect of FD or debt securities issued by it, and none of the promoter or director of the company are a fugitive economic offender. And in case there are some outstanding convertible securities, then the company will have to make reservation for the convertible portion of those securities. So, for example, there are some outstanding CCDs as on date, and which will be converted into equity after say 1 year. Then the company will today. Now the company will have to make the reservation today while giving bonus issue to other equity shareholders in the similar proportion for the convertible security holders, and which will be credited to them once the securities are converted into equity shares. Next, in case there are some outstanding SR shares and if bonus are issued to the SR shareholders, the voting right on those bonus shares should be equivalent to the ordinary shareholders. Now, this is with respect to the conditions. Next, moving ahead with the taxation aspects. So, as per Rule 40 BB of income tax rules, the cost of acquisition in case of bonus shares is nil, and therefore no tax is levied on the shareholder or the company at the time of allotment. Now, here it is interesting to note that as per Section 2/22B of the Income Tax Act, when a company distributes to its shareholders debenture, debenture stock, or deposit certificates in any form, or when it distributes bonus to its preference shareholders, then they are considered as deemed dividend, and therefore which would be taxed pursuant to the taxation of dividend, which I'll be discussing in the later part of my presentation. So this is about the taxation in case of bonus. So like after that, in case of bonus issue, when the security holders who have received bonus shares, when they dispose it off, so tax is levied at the time of disposal. So from here, what can be concluded is that in case of bonus, there is no taxation neither in the hand of the company, nor in the hands of the shareholders at the time of allotment. However, when the shareholder disposes the shares, then the tax is levied in accordance with the Income Tax Act under the head of capital gains. So let's just discuss this particular point in detail. So when it comes to taxation at the time of disposal, there could be two cases. Case number one, when the shares are held in demat form, and case number two, when the shares are held in physical form. So in case of demat forms, since like the shares are fungible, so according to section 45(2)(a), 45/2A of the Income Tax Act, the shares, like the cost of acquisition and the period of holding, should be on the basis of FIFO method. Let's just understand it using an illustration. So suppose, for example, Mr. X, who holds 100 shares of XYZ Limited, he acquired those particular shares, say for rupees 50 per share, and post that the company issued bonus shares in the ratio of 1:1. So now Mr. X holds 200 shares, 100 which he was holding prior to bonus and 100 shares which he received on bonus. So as I've already mentioned, in case of demat shares, it is the cost of acquisition and period of holding is considered pursuant to the FIFO method. Therefore, if Mr. X desires to sell off 100 shares after you have received bonus at the cost of say rupees 25, then the cost of first 100 shares would be considered as 5,000 rupees, and the cost of next 100 shares which you receive free of cost in the form of bonus would be considered as nil. Now, when he sells off this 100 shares, there would be a capital loss on sale of rupees 2,500. Now, how does this 2,500 comes? So he acquired the first 100 shares for rupees 50, which he sold at rupees 25. So 50 minus 25 comes to 25, and 25 into 100 comes to 2,500. Next, when it comes to shares held in physical form, since the shares have distinctive numbers, therefore it is very easy to ascertain as to which shares I am selling it off. So for example, Mr. X, who holds 100 shares of ABC Limited, acquired those shares at rupees 50, pursuant to which he got bonus 100 shares in the ratio of 1:1. So he was holding 100 shares, and after bonus he got 100 more shares. So now its shareholding comes to 200 shares. Now if he sells off those shares which is received as bonus, then in that case there would be a capital gain on sale, because now we are, since the shares are in physical form, we are like very easily able to understand which shares he is selling it off. So when he's selling the shares received on bonus, in that case, since the cost of acquisition was 0, then 25 minus 0 into 100, that is 2,500. There's a capital gain of 2,500 in this particular case. So this is with respect to taxation at the time of sale of shares, of bonus shares. Next, after this, let's just move ahead with the second mode of distribution of accumulated profits to the shareholders, that is by way of buyback. Now, when we look at the legal framework that revolves around buyback is Section 68, 69, 70 of Companies Act, which is to be complied by all the companies, whether it is listed or unlisted. Next, there is Rule 17 of the Company Share Capital and Debenture Rules. And in case of listed companies, they also need to comply with the SEBI Buyback of Securities Regulation 2008. So, like in case of all the companies, they have to comply with 68, 69, and 70 of Companies Act and Rule 70. And in case of listed company, there is an additional requirement of complying with the SEBI Buyback of Securities Regulation. Moving ahead to the sources with which buyback can be done. So the company can either use the free reserves or securities premium or out of the proceeds of fresh issue for the purpose of buying back the securities. Now it is to be noted that when the company uses free reserves or securities premium for buying back, then pursuant to Section 69 of the Companies Act, an amount equivalent to the nominal value of the shares is required to be transferred to capital redemption reserve (CRR). Now, while discussing the sources for bonus issue, as I mentioned about CRR, so this is that particular CRR which is created while we buy back shares out of free reserves or securities. Next, like when the company uses proceeds of fresh issue, it is to be noted that buyback cannot be made out of proceeds of earlier issue of same class of securities. So this is with respect to the sources of buyback. Next, moving ahead with the limitations. The limits on how much shares the company can buy back. So if the company is considering to utilize only up to 10% of its paid up equity capital and free reserves, then a board resolution would suffice. However, if the company wants to buy back in excess to that, up to 25% of the paid up capital and free reserves, that is equity plus pref, then in that case, shareholders approval by way of a special resolution is required. However, in any situation, whether it is by way of board resolution or by shareholders resolution, the overall limit on buyback is up to 25% of paid up capital. So this is with respect to limits. Next, moving ahead with the conditions for buyback. So there are some of the conditions that I have specified here with respect to buyback that all the companies need to comply. First of all, it is to be authorized by the articles of the company. Requisite resolution with the board or shareholders resolution, as the case may be, has been obtained. And post buyback debt equity ratio cannot exceed 2:1. And like when the company is going for buyback, only those shares can be bought back which are fully paid up, and no second offer for buyback can be given until expiry of 1 year from the closure of previous buyback. So if the company has completed the buyback, so for example, the previous buyback has closed on 1st January 2022. So the company cannot give second offer for buyback until the expiry of 1 year from 1st January 2020. Next, buyback is required to be completed within a time of 1 year, and the notice of the meeting for which like special resolution is required should be accompanied with an explanatory statement which should specify as to the reason behind buyback, how much funds would be utilized in buyback, and certain other conditions. Also, the company is required to file the letter of offer with ROC in SH8 and dispatch the same to the shareholders within 20 days at max from the date of filing it with ROC. Next, a declaration of solvency is required to be filed with ROC and with SEBI in case of listed companies in form SH9. And immediately upon the closure of buyback, immediately after the closure of offer, the company is required to deposit the entire sum that it will be utilizing in buyback in a separate bank account. And once the securities had been bought back, it is to be extinguished and physically destroyed within 7 days of buying back. Also, next, the company cannot go for further issuance of shares up to next 6 months, where there is a condition that the company can go for. So, for example, there are ESOPs and certain other such cases, then that is still permissible. However, the company cannot go for further issuance of shares for next 6 months. And the company is required to maintain a register of buyback in form SS10, and it is required to file with ROC and with SEBI in case of listed companies a return within 30 days of completion of buyback in form SH11. So this is with regard to the conditions for buyback. Next, moving ahead with the taxation aspect. So it is quite interesting. I have divided this particular aspect into two halves. First, what happens in the in the hands of the company when it buys back shares, and second, what happens in the case of shareholders. So first, when we look at what happens in the hands of the company, under the same is taxable under 115 QA of the Income Tax Act, read with Rule 40 BB, wherein it is provided that the tax on buyback is levied at the rate of 20% plus 12% surcharge and 4% HEC, which comes to an effective rate of 23.296% of the distributed income. Now let's just understand what is this distributed income. So distributed income is actually the consideration that has been paid by the company for buying back the shares less the consideration which it has already received from the shareholders. To understand it, let's just look at the illustration given here. So here it is written that X Limited bought back shares issued at ₹20, which includes a premium of ₹5 for say ₹100 per share. Then in this case, distributed income is 100 minus 20, which is 80. And accordingly, the tax is required to be paid at the rate of 23.296% of this distributed income of ₹80. So this is with respect to taxation in the hands of the company. Next, when it comes to taxation in the hands of the shareholders, under Section 46A of the Income Tax Act, it is said that in case of buyback, tax shall be payable on consideration received from the shareholders less cost of acquisition. However, when we read the exemptions provided under Section 10/34A of the Income Tax Act, there it is written that income arising on account of buyback is not included in the income of the shareholder. Further, Section 115 QA of Income Tax Act also starts with a non-obstinate clause, as per which the tax is borne by the company only. Hence, it can be concluded that in case of buyback, the incidence of tax is only in the hands of the company, and there is nothing which is taxable in the hands of the shareholders when it comes to buying back of the shares. So this is about the buyback, the corporate law and tax implications with regard to the buyback. Next, we are moving ahead to dividend. Now, when we speak about dividend, the legal framework that revolves around dividend is Chapter 8 of the Companies Act, read with the Declaration and Payment of Dividend Rules 2014 and Secretarial Standard 3, which is the compliance of which is voluntary as on date. Now, when we speak about dividend, so dividend can be of two types, interim dividend and final dividend. So let's just discuss the distinction between interim dividend and final dividend and various parameters one after one. So when it comes to authorization, in case of interim dividend, the same is required to be authorized by way of a board resolution. And the various point of time when interim dividend can be declared are two. First, it could be any time during the financial year, or second, after the closure of financial year but before the holding of AGM. So for example, the AGM of a company is scheduled to be held on say 30th of September. Then in that case, this interim dividend for the previous year, that is 21-22, can be given before the AGM of the company is held on 30th September. Now, the various sources with which interim dividend can be declared are three. First, out of the surplus and profit and loss account. So this particular source can be utilized. It doesn't matter like for which point of time we are declaring dividend. Second, out of profits of financial year for which interim dividend is sought to be declared. So the term financial year in itself relates to a complete financial year. Therefore, this particular source can be utilized only in the second point of time when we are declaring dividend, that is after the closure of financial year, but before the holding of AGM. Now, the third source is out of profits generated in the financial year till the quarter preceding the declaration. So here, this particular source can be utilized in like whatsoever point of time we are declaring in interim dividend. Now, when it comes to inadequacy of profit, so for example, there is loss during the current financial year up to the end of the quarter, for which quarter immediately preceding the date of declaration of interim dividend. Then in that particular situation, the maximum dividend that can be declared cannot exceed average of the rate of dividend declared in the preceding three financial years. So this is with respect to the interim dividend. Next, moving ahead to the final dividend. In case of final dividend, the board recommends the declaration of final dividend, which is subsequently approved by the shareholders in the AGM. Next, final dividend can be declared only at the time of AGM. It cannot be declared after that or before that. And the various sources with which final dividend can be declared includes profits of current financial year and preceding financial year or years after we have provided for depreciation in accordance with Schedule 2, or funds provided by CG or SG for which a separate reserve is to be created. So this is with respect to the sources of final dividend. Next, when there is loss or when there is inadequacy of profit, then in that particular situation, final dividend can be declared. However, the provisions mentioned in the rules are to be complied, which I'll be discussing in my very next slide. So, in case of payment of dividend, when there is insufficiency of profit, then the dividend can be declared out of accumulated profit earned in previous years and transferred to the free reserves. However, there are certain conditions that are to be complied, out of which the first is the maximum rate of dividend that a company can declare in case of insufficiency of profit cannot exceed the average of the rate of dividend declared in the preceding three financial years. Now, so for example, the company has not declared any dividend in any of the three preceding financial years, then this particular condition does not come into picture. Next, when it comes to the maximum amount that can be drawn from the accumulated profits for the purpose of declaring dividend cannot exceed 10% of the paid up share capital and free reserves. And after the company has withdrawn the funds, it is to be noted that balance after withdrawal cannot fall below 15% of the paid up share capital. Also, once the funds have been withdrawn, they are to be first utilized in writing of the losses. Now here there is a catch. When we read the provision written in the rules, there it is said that the amount so drawn can shall first be utilized in setting of the losses incurred in the financial year in which the dividend is declared. However, when we read the provision mentioned in this section, it says that no company shall declare dividend unless carried over previous losses and depreciation not provided in previous year or years are set off. So, in rules, they are written that the amount so withdrawn shall be first utilized in writing of the losses of the financial year pursuant to which the dividend is declared. However, in section it is written that the amounts of withdrawn shall be first utilized in writing of all the losses of previous year or years. Obviously, what is written in section should prevail, and so our accumulated profit is actually like our khazana. Like if we are using our khazana, then that is to be first utilized in writing of all the losses, and post which we can consider declaring dividend. Therefore, what is written in section prevails over what is written in the rule. Next, moving ahead with respect to the condition, there are certain conditions which are to be complied while going for dividend. So the first is Section 8 company cannot declare dividend. So like not just dividend, but Section 8 company can neither go for bonus or buyback, as we have already discussed at the very onset of our session. Next, dividend declared out of profits of the company, like only that part of the profit should be considered which is provided, which is used after we have provided for depreciation as per Schedule 2 of the Companies Act. Next, unrealized gains or notional gains or revaluation, profit, loss, etc., are to be excluded from the profits, which you'll be using for the purpose of dividend. Next, in case of inadequacy of profits, dividend cannot be paid except in accordance with the rules, as we have already discussed that when there is insufficiency of profit, the company, if it wishes to declare dividend, then it has to comply with the provisions mentioned in the rules. Next, no dividend can be paid out of reserves except free reserves. That is, only free reserves portion can be used for the purpose of declaring dividend. Next, dividend once declared is to be deposited in a separate bank account within 5 days of declaration. So, I'll be discussing with respect to the timeline of the dividend payment, in the later part of my presentation. Next, as per the provisions of Companies Act, dividend can be paid only in cash. And if there is any default of Section 73 or 74, then or in case there are in case there is any subsisting default of redemption of debentures of payment of interest or creation of DRR, or in case of like there is a default of redemption of preference shares or creation of CRR, or when there is any default in payment of dividend declared in current year or previous years, then the company cannot declare dividend until it has made good all these defaults. Also, there should be no subsisting default in repayment of any term loan from bank or financial institution, or in payment of the interest accrued on those particular loan that the company has obtained. So if the company complies with all of these conditions, then only it can go for dividend payment in addition to the condition which we have already discussed. Next, moving ahead with the dividend declaration and payment. So here I have presented the timeline of dividend payment. Here, one particular point which is very significant to note is that once the dividend has been declared, the same is to be paid within 30 days of declaration, except in certain conditions, except in certain situations. Like for example, there is some, so the company have adjusted the amount of dividend with some amount that was unpaid on the shares, or because of some operation of law, or in certain exceptions which are provided under section 127, the company has to pay off the dividend within 30 days of its declaration. And in case the company fails to do so, except in the cases that I just mentioned, then every director of the company who is knowingly a part of this default shall be punished with imprisonment of 2 years and a fine of rupees 1000 per day, during which the default continues. So since there is imprisonment and fine for this particular non-compliance, or say for example this particular default, then the punishment is actually non-compoundable, which means if this default has been made, then the company cannot go for compounding. So compounding can take place when the punishment is only fine or imprisonment. However, when it comes to defaults which are punishable with fine and imprisonment, or with only imprisonment, then the same becomes non-compoundable, and the company and the officers in default or the directors in default will have to like will have to bear those particular punishment. Apart from this non-compliance, for any other default with respect to the provision of dividend, there is only there is only penalty amount, which is still bearable when it comes to the default of non-payment of dividend within 30 days of its declaration. Next, moving ahead with the taxation aspects of dividend. So up to 31st March 2020, there was this concept of CDT under Section 115O of the Income Tax Act, pursuant to which whenever the company declared dividend, it had to pay a corporate dividend tax of 20.555%, which comes from grossing above 15% and adding surcharge and HST to that. However, and in the hands of the shareholders, nothing was taxable up to 31st March 2020 and up to rupees 10 lakh. So if the dividend received by the shareholder exceed rupees 10 lakh, then in that case, the shareholder was required to pay tax on the additional portion at the rate of 10%. So this was the scenario up to 31st March 2020. With effect from 1st April 2020, the concept of CDT was omitted pursuant to the Finance Act 2020, and now the dividend is actually taxable in the hands of the shareholders, basis their slab rates. And in case of companies, although there is a carve-out that is provided, which we'll be discussing in the later slides. So this is with respect to dividend taxation as on date and what it was up to 31st March 2020. Next, when it comes to dividend taxation of dividend in the hands of the shareholders other than companies, then if the shares on which the dividend is received is held as investment, in that particular case, the dividend received is taxed under the under the head of other sources, and there is no deduction of any expense that is provided except interest expense, and that too up to 20% of the 20% of the dividend total dividend received, or the actual interest expense incurred, whichever is lower. So I repeat again, in case of shares held as investment by the shareholder other than company, in that case, dividend income is taxed under the head of other sources, and there is no deduction of any expense that is provided except for interest expense, and that too up to the lower of the actual interest expense incurred, or 20% of the total dividend. However, when it comes to the shares, dividend on shares which are held as stock in trade, even in that particular case, the dividend income is taxed under the head of other sources. Now, however, say for example, there's a business loss, right? So in that particular case, the dividend amount received can be first utilized for the purpose of setting off of the business losses, and post with the remaining portion, if any, shall be taxed under the head of other sources. So I'd like to explain this with the help of illustration. So as can be seen in the previous year, as you can see over here, in the previous year 21-22, X Limited incurred a business loss of rupees 2 lakh and earned a dividend income from shares held as stock in trade of rupees 2,25,000. So in this particular case, dividend income up to 2 lakh rupees shall go under the head of income from profit and gains from business and profession for the purpose of setting off of losses, and the remaining 25% shall be taxed under the head of other sources. So this is with respect to taxation in the hands of shareholders other than company. Next, when it comes to intercorporate dividend, So the same has been divided into two particular halves. First is when the same is received from a domestic company, and second when the same is received from the foreign company. So in case the dividend has been received from a domestic company, it is taxable at the normal tax rate like that, which could be 30% or 25%, 22% or 15% as the case may be, or like in which option the company has opted. And no deduction of any expenses allowed except interest expense, which under section 57, which I have already discussed. However, under chapter 6A, there is a section called section 80M, pursuant to which if the company declares the dividend portion which it has received in the form of dividend from other company, then the same shall be reduced. So I'll simplify the same. For example, the company has received intercorporate dividend, then the same shall be reduced from its total income if it declares the same portion to its shareholders. Okay. However, there is a condition that the same is to be distributed at least 1 month prior to the date of filing of return. So this is with respect to taxation of intercorporate dividend received from a domestic company by a domestic company. Now, when it comes to dividend received from a foreign company by a domestic company, there again there is a bifurcation in two halves. First, when the Indian company holds at least 26% in that foreign company, and next when it holds less than 26% in the foreign company. So when the Indian company holds less than 26% in the foreign company, the provision similar to that with respect to dividend received from domestic company comes into picture. However, when the Indian company holds more than or say at least 26% in the foreign company, in that particular case, the dividend income is taxable at the rate of 15% plus surcharge plus HEC under section 115 BBD of the Income Tax Act. And no deduction of any expenses allowed, whether it is interest expense or any other expense. No deduction is allowed in this particular case. However, deduction under Chapter 6 under Section 80M of Income Tax Act is still available. Next, moving ahead with the comparative analysis of the various modes. So here I'll be discussing on various parameters or like what all things are there in case of bonus, buyback and dividend. So as to come to a conclusion as to which particular option becomes beneficial to the company in different situations. So when it comes to the provision of law that is to be complied in case of bonus shares, as you already discussed, Section 63 of the Companies Act read with the rules are to be complied by all the companies. However, in case of listed companies, additionally, the provision of ICDR regulations of SEBI is also required to be complied. When it comes to buyback, Section 68, 69 and 70 of the Companies Act read with the rules is to be complied along with the buyback regulations in case of listed companies. And when it comes to dividend, Chapter 8 of the Companies Act read with the rules, and in case the company also opts to comply with the secretarial standards, which is voluntary as on date, is also required to be complied. So understanding the provisions is also important because ultimately how much compliance is there in each of the option is also required to be analyzed before deciding as to which particular option we are going to opt. Next, when it comes to shareholders approval in case of bonus issue, shareholders approval is required by way of an ordinary resolution. However, in case of bonus, the same is required only if the amount to be utilized exceeds 10% of the paid up equity capital and free reserves. And in case of dividend, shareholders approval is only required in case of final dividend, and no shareholders approval is required in case of interim dividend. Next, when it comes to outflow of fund in case of bonus, as we have already discussed, there is no direct outflow of money from the company to the shareholders. However, in case of buyback and dividend, there is outflow of money. Next, when it comes to timeline, in case of bonus issue, there is no timeline that has been provided in the Companies Act. However, buyback, in case of buyback, the same is required to be completed within 1 year. So once the buyback, like the company is going for buyback, it is required to complete the same within 1 year. And in case of dividend, it is very, very important to note that the same is required to be paid within 30 days of declaration. If there is any default, non-compoundable offense is levied on the directors who are in default. except in the exceptions provided under Section 127 of the Companies Act. Next, when it comes to taxation, in case of bonus issue, there is taxation only when when the shareholder disposes of the shares, and there is no taxation at the time of allotment, neither in the hands of the company nor in the hands of the shareholder. And in case of buyback, there is tax. Tax is only levied in the hands of the company at an effective rate of 23.296%. And in case of dividend, as we have already discussed, the same is taxable in the hands of the shareholders on the basis of the slabs in which they are falling. And next, when it comes to maintenance of debt equity ratio, it is to be noted that in case of bonus and dividend, there is no requirement of maintaining post-event debt equity ratio. However, in case of buyback, a minimum post-buyback debt equity ratio of 2:1 is to be maintained. And in case of government company NBFCs, there's a higher limit of 6:1. Now, the limits up to which the company can go for bonus, then there is no limit provided in the law when it comes to bonus. However, when it comes to buyback, the maximum limit of 25% of paid up capital has been provided for buyback. And in case of dividend, also there is no limit except in case of inadequate profits. However, the company obviously cannot exceed the reserves, the amount of reserves it has. So, like whatsoever reserves the company has, it can utilize that in case um, there is no event of inadequate profits. Next, with respect to penal provisions, in case of bonus issue, there is no specific punishment that is provided. Therefore, Section 450 of the Companies Act comes into picture. So, as per Section 450 of Companies Act, if in Companies Act 2013 there is any non-compliance for which no specific punishment has been provided, then the same shall be punished in accordance with Section 450 of the Act. However, in case of buyback, when there is any non-compliance, the same is punishable with fine, which is compoundable. And in case of dividend, as we've already discussed, if the same is not paid within 30 days, then fine and imprisonment is levied, which is like a non-compoundable offense. Apart from this, there is for any other non-compliance, there is penalty amount which is levied, which is like still fine. However, like when it comes to payment of dividend, it is quite strict. So the company should ensure that it pays off the dividend within 30 days of its declaration, except in the except in the events of exception provided under Section 127. So the companies, before opting for as to which option should it go for when it comes to distribution of accumulated profits, then it will have to actually analyze on the parameters which I've mentioned. This is actually an illustrative list of parameters. There are various other parameters as well that the company needs to comply, and basis that on analysis on different parameters, a decision is required to be made. And that's it from my end for today's session. If anyone has any doubt or any query with respect to the presentation, then please feel free to uh, drop your queries or concerns in the comments below. And that's it from my side. Thank you, everyone.